Hi everyone. I hope everyone had a wonderful Diwali and welcome to episode 9 of Learn on the Go. Today I want to talk about a small cap company. I think the label small cap is definitely an exaggeration for Fredun Pharmaceuticals, which at the time of recording this video is at a market cap of 770 crores, which puts it in terms of ranking at 1700th largest company in the country. So it's not a small cap, it's not even a micro cap, it's more like a nano cap, but it's been in the news lately. They've recently acquired some tech enabled platform. They've also introduced India's first pure gen dog biscuit. It's called Snacky Gen, completely free from root vegetables, meat, and all animal derived ingredients. And most importantly, the company's stock price has absolutely rocketed up, not because of Snacky Gen, but for what the company is doing and what its plans are for the next 3-4 years. I first invested in this company sometime in July, again in August and in September. And I had to wait for 30 days before creating this video because that's what the SEBI rules require research analysts like myself to do. I request you to read this disclaimer, but in a sentence, what it says is don't take anything I say as a recommendation. Don't trust me. Do your own research. The wins are yours, the losses are yours, and I am not a party to anything you do, think, or say based on the contents of this video. I don't think I could have said it more explicitly, so let's start with a quick company overview. So, Fredun Pharmaceuticals Limited, or FPL, was incorporated in the year 1987 by Mr. Nariman Medhora and his wife, Dr. Daulat Medhora. In 1994, they set up an export-oriented pharmaceutical unit in Palghar. Growth was slow and steady, and I'll say it was around 2017 when FPL began aggressively expanding its manufacturing capabilities and diversifying its product portfolio to include ointments, creams, gels, pellets, etc. A lot of these changes coincided with the second generation of the family taking over. Mr. Fredun Medhora, who is the promoter's son and also on whom the company is named, in 2014 he became the managing director of the company and continues to hold that post. Under his management, SPL has increased the number of products from just 63 in 2007 to almost 700. It does its business in 52 countries and has some 1,200 plus products under registration globally. The company has also diversified strategically, and in addition to generics, which is the bread and butter of the company, Fredun is also into pet care, nutraceuticals, cosmeceuticals, and also mobility. FPL operates a state-of-the-art manufacturing facility in Palghar, Maharashtra, and also products through contract manufacturing at 37 different locations. The company has also been doing a lot of automations to increase efficiency and throughput. Okay, now that we know where the company stands, let's look at the revenue. And in 2014, when Mr. Medhora became the managing director of the company, the sales were a mere 21 crores. Since then, the company has grown by leaps and bounds, and today its revenue is almost 25 times of where it was just 11 years back. What's remarkable is that the company has managed a growth rate of at least 15% in most of the years except this one, FY18. And please recall, this was one of the coffee can criterias wherein the company that qualifies under the coffee can setup needs to have a growth rate of at least 10% for each of the past 10 years. So FPL comes very close to that, and if any of you have a coffee can portfolio, then you can definitely explore if Fredun Pharmaceuticals makes the cut for you. The other rule is that the ROC has to be over 15% for each of those 10 years, and in the case of Fredun Pharmaceuticals, we see that it's kind of there, it's been more than 15% in a number of years, except maybe these 3 years. Right now it's 19%, but one thing one has to remember is that Screener has a very different way of computing the ROC as compared to what I use. So the way I calculate ROC is to take the EBIT in the numerator, and in the denominator there's the summation of shareholders' equity, which is the equity share capital plus the reserves and surplus, and the company's long-term debt. Now, this long-term debt is where the confusion is, because some people tend to take the total debt, that is the long-term and the short-term borrowings, which can have a big impact on the numbers. Okay, so let's do it for Fredun Pharma. Let's go to the profit and loss account, and Okay, so EBIT is nothing but your operating profit minus the depreciation. So 55 minus 4 gives us 51 crores. And for the denominator, let's go to the balance sheet and we have the shareholders' equity, which is your equity capital plus your reserves. So that's 142. And in borrowings, which is where the entire confusion is. So as per my calculations, I would prefer to take 10 crores. So 142 plus 10 gives me 152 crores. Okay, let me open a calculator. There we go. 51 is the numerator, the EBIT, divided by the shareholders' equity plus the long-term debt, which we computed at 152 crores, and this comes to 33.5%. So my version says that the ROC for Fredun Pharmaceuticals for FY25 is 33.5%, while what you get on screener is about 19%. The reason I prefer long term debt is because when we are trying to compute capital efficiency, that is how well the company is using its capital, what we are really interested in is permanent capital. So, for example, shareholders' equity is definitely permanent capital. I don't think there's any doubt about it. And when it comes to long term debt, again, long term debt is something that will be there in the books for a very long time. So, it's kind of permanent in nature, although it will come down over time. But I hope you can understand. So, equity plus long term debt, this constitutes the permanent capital of the company, which is what really helps in financing the long term growth of the company, which is why I prefer using long term debt in my ROC calculations. Now, in terms of the business model, what Fredun Pharma does can be divided into two parts. The first is the vintage business, which is largely generics and it's the bread and butter of the company, while the second are the new age businesses. This distinction is important because until FY22, we had almost the entire revenue coming from generics, 99.7%. But as of December last year, so Q3 of FY25, this number has gone down to 88%. In a recent con call, the management further clarified that 350 out of the 456 crores of revenue the company did in FY25 was the vintage bit, which means the share of new age businesses is around 23% now, and in a few years, it is projected to be like half of the company's total revenue. So one can say FPL is right now at an inflection point in its journey. Let's come to the specifics, and the vintage business, which is entirely generics, consists of a number of things. The company's export business, which was 77 crores in FY25, is on the rise. Third-party contract manufacturing, which FPL is trying to reduce over the next 3-4 years. And of course, they have their own distribution, which all totals to about 350-360 crores of revenue in the last financial year. Much of it comes from the 697 product registrations the company has successfully secured across 23 therapeutic areas such as anti-diabetes, antibacterial, anti-malarial, etc. In fact, there's a pipeline of some 1,290 products for future registration over the next 3 to 4 years, which supports the management's belief that they can consistently grow their vintage business by 15 to 18% for the next 7 to 9 years. One can also think of this as the company's cash cow, as it not only fills the company's coffers, but also provides the foundation for the rapid expansion and diversification of the company into new age businesses. Okay, now that I've said it, let's look at the new age businesses. These are high growth, high margin, consumer centric businesses that the company is pivoting into. The first one is pet healthcare, which operates under the brand Freossi. The company's vision here is to build a complete pet care ecosystem which will cover MCHC based supplements, a natural source of calcium and phosphorus, animal feed additives, grooming products, and also pharmaceuticals for pets, poultry, and cattle. The company has also done a couple of acquisitions. One, Pet Stop Private Limited, that has an existing base of 4,000 paying customers in the Mumbai region. Recently, FPL also acquired the assets of Wagger.ai, a pet tech platform which has a user base of 140,000 pet parents. And just last year, FY25, the company launched what is India's first dedicated 24 by 7 advanced pet diagnostic center with plans of expanding it to 7 more cities in due course of time. Over the last 3 years, this pet healthcare division has seen its revenue grow many times. It presently clocks about 30 crores. And with the pet care industry in India growing at 17% per annum, the management rightfully expects great things from this division. Nutraceuticals is FPL's second new age business, which focuses on human health and wellness using natural active ingredients, so not everything is for pets. This comes under the Fredun Nutrition brand and includes immunity boosters, liver support, fertility enhancement, and also herbal supplements. In terms of revenue, Nutraceuticals clocked a revenue of around 16-17 crores in FY25. And again, the management has high hopes given that this market is projected to grow at 13.5% until 2030. Next up is Cosmeceuticals or Dermaceuticals, which aims to tap into the increased awareness for anti-aging, sun care, hair care, organic products, etc. FPL has two divisions here. Bird and Beauty, which is a bit premium and offers emu oil enriched products. These are known for their moisturizing benefits. And then there's Beauty Fred for the mass market, which can be found in retail outlets at key railway and metro platforms across Mumbai. Last year, FY25, this division generated a good 15.5 crores in sales. The fourth new age business in the FPL stable is Mobility Aids. Launched in FY24, this consists of rehabilitation products like ankle binders, knee wraps, heel cushions, cervical collars, walking aids, etc. It also includes pain management products like Chew Balm, which is marketed as a very potent and affordable balm. This reminds me of Tiger Balm for headaches. My mom used that often. Anyways, this division did manage a very respectable 18-19 crores of sales in FY25. And the fifth and final new age business is in fact the generics business. It's actually branded generics under the Fredun GX brand. And here the focus is on providing high quality generics to the Indian market, that is the tier 2, tier 3 and tier 4 markets. On last count, this division has launched over 110 products with another 50 lined up, and it caters to a range of therapeutic categories like anti-diabetics, antifungal, antibiotics, etc., and to a range of customers including institutions and government, like this 15 to 18 crore tender the company was awarded for generic medicines by the Tamil Nadu Medical Services Corporation. Fredun GX did around 55 to 60 crores last year, that is FY25. The management has guided for 85 crores in FY26, 150 crores in FY27, and has an internal goal of building a basket of 500 plus products and generating 250 to 300 crores in sales, latest by FY28. I know there's a lot of numbers, so for better comprehension, I have compiled all of this under this single table here. And from the looks of it, Fredun Pharmaceuticals has their work cut out for the next 3 to 4 years. In fact, when one of the equity analysts covering this company asked for some guidance, the management projected a doubling of revenues and PAT over the next 3 to 4 years. More specifically, the number was 800 crores of top line and 90 plus crores of PAT. And what is it right now? It's 456 crores of sales and a PAT of 21 crores. Okay, let me quickly pull out the calculator. So it says 3 to 4 years. So let's take 3.5 as a midpoint. So we're looking at 800 crores of projected sales divided by 456, which is current sales, raised to the power 1 divided by 3.5. This comes to 1.174 minus 1, which gives us 17.4%. Sales CAGR over the next 3 to 4 years. In terms of PAT, it will be a bit higher. Let's try that as well. So it's 90 plus crores is what the management says. So 90 divided by 21, which is the current PAT, FY25. Raised to the power 1 divided by 1.5, 3.5 years, which gives me 1.515. So that's minus 1. So 51.5, 52% increase in PAT every year. So a 3.5 year CAGR is 52%, which should augur well as far as the stock price is concerned. So definitely something to watch out for. Also, in terms of valuation, let's move over to the PE ratio, the most basics of valuation measures. And yeah, see this. It's been a company which has always been on a higher path as far as the price earning multiple is concerned. It tapered down to about 16, and it's now kind of taking a U shape, and it's currently at about 33.5. More than the dark blue line, I think what's more impressive is the light blue bars which are there, and it shows a very nice steady growth in EPS on a quarterly basis. I kind of prefer these companies. I'd even talked about it in a video. Yeah, this one, finding future multi-baggers. Let's just look at this. Yeah, great. So that's perfect 9 companies I've knocked off, and now see, based on whatever criteria that was there in that video, I had come out with some 20, 21 odd companies. And see, one of those companies happens to be Fredun Pharma. So I might have invested in one or two others as well. But Fredun Pharma is one of the things which I had identified using this video as an example. And when was this done? See, the video came out on 9th of July. So it was pretty much around the time I would have also invested in Fredun Pharma. So yeah, कुछ चीजें ध्यान रखनी चाहिए. So nice. Yeah, very happy to see this. Also note the market cap of Fredun Pharma on the day I had published this video was, or in that week of making that video, was 380 crores. And today it's at 770 crores. So there's been a nice, a doubling of the stock price over the last 3 months, which kind of inspires a lot of confidence in me, definitely. Now, let me just go back. Now whether this 33 P ratio is a good entry point or not, I think I'll leave that to your judgment and to your analysis. But more than the P ratio, I think I really want you to look at the rise in EPS, the way it's happening. That should be the primary lever of your analysis. That's what I think. And yeah, while I do agree that the entry point is very important, you also need to measure that against what the company's future over the next 3, 4, 5 years holds. That said, not everything is happy, hunky, and dory here. There are a few itchy points, so let's look at those as well. Firstly, in terms of borrowings, we can see that the debt has increased massively. It was 40, maybe 50 crores in FY 21-22. It's now up to 166 crores. But the pleasant thing is that the long-term debt is not much. It's just 10 crores. Most of it is your short-term borrowings, which is largely on account of working capital. And in fact, the company recently infused some capital, about 153 crores. This was done via a preferential issue of equity shares and convertible warrants. Understandably, this was done to support SPL's aggressive expansion. And as I've shown in yet another previous video, if you're doing a financial projection, then don't forget to account for an increase in the number of shares. Another point, and something that we should all take cognizance of, is the cash flow from operations. So see this, it's been negative in almost every year, minus 11, minus 2, minus 14, and now it's minus 29 crores. And a large part of that has to do with the receivables and the inventory position in the company. Let's start with the inventory. And if inventory days were to move up from 96 to 265 days, then it's definitely an area of concern. Just to put it very simply, 265 days means that about 9 months of the company's inventory is unsold, which can be either in the form of raw materials or in the form of finished goods. This is obviously not an ideal situation, as it ties up a lot of cash. And as a number, there's about 200 crores of inventory as of 31st of July this year. That said, the management expects inventory levels to be high for the next 6 to 7 quarters, with the expectation that inventory days will come down to 125, 130 days over time. But I personally think that would be a stretch given the high number of SKUs that the company has. Okay, let's examine the receivables as well and see here. It's gone up sharply from 68 days to 142 days as of March 2025. Again, in very simple terms, it means that SPL's customers are taking almost 5 months to pay back, which is again not an ideal scenario. Presently, the receivables number, which was a solid 177 crores as of March 2025, the management now reports that this has come down to less than 100 as of 31st of July 2025, which shows that the management is working on things. But my own assessment is that all three, that is cash flow from operations, the inventory days, and the receivable days, all these three elements will take at least a couple of years for them to show some kind of a normalcy. And this is very common with companies that are trying to grow sales at a very healthy clip, and also those which are there in the B2C space. After all, such companies will need to keep more inventory to meet demand, and in FPL's case, it has a lot of stock keeping units. These companies often extend credit at liberal terms, so beyond the regular 3 to 4 months to capture more market share, and over time they pull back these extra incentives. More the sales, higher are the receivables. It's a very natural phenomena. And just like Fredun Pharma recently raised capital, those 153 crores, most growing companies do need to top up their coffers. One might even call it a necessary evil, which is what I believe Fredun Pharmaceuticals is going through at this stage of their growth. And if you're looking to evaluate this company, then you have to get comfortable with these uncomfortable realities of this particular business. Of course, there's a lot more to look and monitor and evaluate. There is the company's management, which is very important when evaluating microcaps. There are certifications, approvals, which is a very important part of this business, competition. So yeah, there's a lot more to look at beyond what we have already covered in this video. In fact, one interesting way of looking at what the company has done and is doing is, okay, let me just read it out to you. So this is what the management said. The results and the numbers that we are seeing in FY26 is for the work that we have done in FY21, 22, and 23. I don't know if you're seeing it this way, but I feel it's absolutely true. And if you are the management or a Purana shareholder of Fredun Pharmaceuticals, this is one image you'll be extremely proud of, with every metric showing improvement. And here's what the rest of it says. What we are doing now, you will see results in FY 30-31 because we plan about 3.5 to 4 years in advance. We now have orders in hand, we have products in place, and the R&D team and the marketing team, a lot of it is in place. So this kind of sums up what Fredun Pharmaceuticals Limited is up to. It's like that video I made where I had, this one, where I explained with examples on how certain companies are increasing their capacity, setting up plants, and essentially getting ready for their next phase of growth. It is my belief that FPL is also at that same stage, with it doing multiple activities ranging from changing the product mix to increasing capacity, doing branding exercises, reducing its dependency on OEMs, etc. And all of this is being done keeping the future in mind. The other thing I want to impress upon is that ambition and scale need not be limited to only the large cap companies or the mid caps. There are hundreds and thousands of companies like Fredun Pharmaceuticals, which are small, even microcap companies that are doing amazing things. And in the case of Fredun, it's one of those many companies that are trying to break into the 1,000 crore revenue club. The more such companies you can identify, the better it is. But having said that, one thought I'd like to leave behind is that all these companies, all these businesses, none of them would travel in a straight line. I mean, there's always going to be certain opportunities and limitations that's going to be around it, which can be in the form of regulations, competition, tariffs, or raw material prices increasing, decreasing, some new opportunity opening up, etc. So businesses never travel in a straight line, and one has to keep that in mind when doing any kind of evaluation. And especially in the case of microcap companies like Fredun Pharmaceuticals, one has to give them a bit more time. It's like you can't change your life in a day. So similarly, you don't expect a company to also kind of do a turnaround on a 3-month basis or on a 6-month basis. That's generally not possible. So why I say this is because at least in this company, we can see there is a kind of a runway, a kind of a growth path which they have created for themselves for the next 3 to 4 years. And obviously, it becomes important for any existing shareholder or for a potential investor to track, analyze, and monitor that runway from time to time. I hope you liked today's video. If you have any questions, if you have any comments, then please drop it in the comment section below. As you know, I read every comment and I reply to most of them as long as it's asked respectfully. Uh, so, so yeah, that's it for today. And again, wishing you and your family a very happy Diwali, and I'll see you very soon. Bye bye.